Good evening, everybody. This is our third session on financial instruments. And in this session, as we started yesterday, we will discuss hedging with the help of a couple of illustrations. And thereafter, we shall discuss what is the difference between hedging guidelines given in ISA 39 and the hedging guidelines, hedging approach given in this new standard. Then we shall discuss International Financial Reporting 7, which are basically disclosures requirements for IFRS 9 and International Accounting Standard 32. During this session, because we tried to cover financial instruments extensively, so I will try to ensure enough pop-up questions so that our concepts which we covered tomorrow and day before which we covered yesterday and day before yesterday could be revised, so that if there is any gray area, we can quickly address that. Of course, not with the help of illustration. Of course, quickly I'll try that. There are a number of like pop-up questions, so be attentive. And I suppose that you people must have gone through the material which you studied yesterday and day before yesterday, and of course, there could be pop-up question related to hedging. Okay, yesterday we discussed like hedging is of two types: fair value hedge and cash flow hedge. And then hedge of net investment in the foreign operation will be either fair value hedge or the cash flow hedge when we will discuss. What is the reason for hedging? Yesterday we discussed at length, it could be speculation, but when we talk about hedge, this is not speculation. In fact, this is risk management. In fact, when you are concerned that due to changes in the future, you may incur loss. So as a result, you try to protect yourself. So whatever technique you adopt, this is termed as hedging. So there are many techniques, but here we are concerned with like how can we classify that technique? Is that hedge is cash flow hedge or fair value hedge? Of course, this will depend on the risk being hedged. So yesterday we saw the definition of fair value hedge. We saw the definition of fair value hedge, and then what was fair value hedge? Let's look at it again. Fair value hedge was a hedge of exposure. A hedge of exposure to changes in the fair value of a recognized asset or liability, or an unchanged or an unrecognized firm commitment, or a component of any such item that is attributable to a particular risk and could affect profit or loss. This was the basic definition of fair value hedge. So here you can see that like asset is already there on your balance sheet, liability is already there on your balance sheet, and you have already made a commitment which is unrecognized. Examples could be like inventory. You have inventory, and that is those inventory items are included in your stock, but you are afraid that this may not fall in value and causing loss to your business. So you go for a fair value hedge. Likewise, fixed rate debt. Fixed rate debt. Say you issued some bonds with coupon like 5% per annum. So this is good that your interest rate is fixed, but you are worried that in the future market interest rate will be much lower than 2%. Sorry, 5%, because we assume that the fixed rate debt is being bonds are issued at a rate of 5%. So you may be worried that interest rate may be much lower than 5%, and you will be overpaying. In other words, you could get the loan at much lower interest rate in the future than you will be paying at the fixed rate of 5%. So therefore, you enter into a interest rate swap to receive 5% fixed and pay, say, LIBOR 12 months plus, say, 1%. So this is a fair value hedge. You tied the fair value of your interest payment to market rates. Then an asset with a current fair value of, say, 200 million, and you are concerned that the asset will fall in value. And an unrecognized firm commitment, the fair value may change. Simple is when you try to hedge something which is fixed for floating, then this means your hedging will be classified as fair value hedge. Okay. So what is the accounting for fair value hedge? Accounting treatment of fair value hedge. See, we shall understand the accounting treatment of the fair value hedge with the help of this illustration. But before discussing this illustration, let's have a look at what is the accounting treatment of the fair value hedge. See, under fair value hedge, the gain or loss, okay, let me explain the other term as well, like hedging instrument and hedged item. Hedged item is that item which is being hedged. Like in our examples for fair value hedge, if you are hedging inventory, so the hedged item is inventory, stock, and how you are hedging that inventory, that will be termed as hedging instrument. For example, if you are using futures to hedge that inventory value, then those future contracts will be hedging instrument, whereas the stock will be your hedged item, the item which is protected from the loss. In fact, this is not the standard definition, but this is the basic understanding. Something which you want to protect, whose fall in value need to be protected, that is hedged item. And the item which is being used to protect yourself, to hedge an item, that will be termed as hedging instrument. Okay, so you hedged an item with a hedging instrument. Now, when the time passes, there may be changes in the value of the hedged item and the hedging instrument. So this change in value will be in the form of gain or losses on these two items. So what you will do, very simple treatment, gain or loss on both hedging instrument as well as hedged item will be transferred to the profit and loss account. If it is loss, of course, profit and loss account will be debited. If it is gain, profit and loss account will be credited. So the treatment is very simple. There is one exception, like if your hedged item is a financial asset at fair value through OCI, then the treatment is as mentioned over here. Then the gains and losses on both the hedged item and the hedging instrument will be recognized in OCI. I repeat again, under fair value hedge, accounting treatment is very simple. The gains and losses both on hedged item and the hedging instrument will be transferred to the profit and loss account. But there is only one exception for financial asset held at fair value through other comprehensive income. Their gains and losses on both the hedged item and the hedging instrument will be transferred to the OCI. So this will not be transferred to the profit and loss. So let's do it practically with the help of this illustration. On 1st July, see, please note that this illustration is there on the GoToWebinar as well as Google Doc link. These illustrations are available there, and the name of the document is Handout FIs Impairment and Hedging. So please download that so that this whole illustration should be in front of you while we do its solution. So it is better, download it, keep it in front of you. Okay, meanwhile, while you are downloading, we can have a small pop-up question from yesterday or today, yesterday and day before yesterday discussion. Mr. Khayyam, can you quickly write a small question? Okay, should I make you write?
Yes.
Financial asset.
Yes.
Which is equity asset.
Which is equity asset.
Can be subsequently measured at amortized cost. Options are no and yes.
No and yes.
And there are two options. So pop it up. While this question is being popped up, very simple and straightforward question. You will have 1 minute for this question. Meanwhile, please utilize this time for downloading of material assets.
Sir, our question statement goes like financial asset. Which equity asset can be subsequently measured at?
Financial assets, which are financial asset, which is an equity asset.
Okay.
Which is an equity asset.
Which is an equity asset.
Will be, what is next?
Can be subsequently.
Can be subsequently measured at amortized cost. Okay, is it? Okay. Yes, no, or yes.
It has been launched.
Okay, write another pop-up question. Write another. Financial assets.
Assets.
Which are financial assets.
Which
are debt instruments.
Debt instruments.
Cannot be
Cannot be
reclassified. Yes or no?
So should I close the question that have been popped out already?
Yes.
Okay, I'm going to close this question. The 52% people are saying no, while rest of the people are saying yes, 48%.
48% people are saying
Yes.
yes. What was the question? Can you?
Financial asset, which is an equity asset, can be subsequently measured at amortized cost.
52% are correct. Please just recall yesterday discussion. Financial asset, which is an equity asset, can never be measured at amortized cost, neither at initial recognition nor subsequently. So please just note it. Those people, those 48% persons who mistakenly answered it. So now this is next pop-up question.
Okay, I'm going to follow the financial asset which are debt instrument cannot be reclassified.
Cannot be reclassified.
Okay, I have launched the question.
Yes, okay.
They cannot see.
But its direction is towards you. So it's more nearer to you.
So I'm going to close this whole question. The results are similar to the old one. 48% people saying yes, while 52% people saying no.
52% people are correct. So at least more than 50% people read something, but this is something very basic, and we studied yesterday. You can reclassify financial assets if there is a change in the model. You can reclassify your financial asset if there is a change in the model. If there is a change in the model. Like previously, contractual cash flow conditions was being met, but now you started selling them as well. Now you can change your model. So when there is a change in model, financial assets which are debt instruments can be reclassified. So I'm giving you a hint that one more pop-up question will come up after like 20-25 minutes on the reclassification. Okay, now come back to our topic. I hope by this time you people managed to download the material, and illustration number 5 is in front of you. Okay, illustration number 5 is on 1st July 2006, ABC Limited acquired 20,000 kgs of a material which it held in its inventory. This cost $100 per kg, so a total of $2 million. ABC Limited was concerned that the price of this inventory would fall. So on 1st July 2006, the entity sold 20,000 kgs in the futures market. So they sold it in the futures market for $105 per kg for delivery on 30th June 2007. On 1st July 2006, the conditions for hedge accounting were all met. At 31st December 2006, the end of ABC Limited reporting period, the fair value of the inventory was 110 per kg, while the future price for 30th June 2007 delivery was 113.5 per kg. On 30th June 2007, the traders sold the inventory and closed out the futures position at the then spot price of 115 per kg. Prepare accounting entries in respect of the above transaction. See, in this illustration, if we just go through the information which we have just read, we can find that this is basically the hedged item, value of 20,000 kg of stock, value of 20,000. This is basically the hedged item. Hedged item.
Sir, one of our attendees have requested to kindly recall the conditions of hedging.
Recall the conditions of hedging. Actually, hedge, if you just see what is the meaning of, in fact, hedge. The meaning of hedge is like to evade or simply to protect yourself against a loss. Okay, I think I'll have to use some other slides in order to explain this point, because I think I moved very quickly to this area, supposing like we have enough discussion on hedging. We have here, okay, let me check if I have here the folder.
No, this is not the folder. You have copied FIS part 3. Yes, this one.
I copied it over here.
Another was IFRS 13, IFRS 7.
Okay, can you give me the flash? Okay, I will try to explain, but this is good that if I use some other material to explain it, so that will be very helpful. No, give me this flash. Give me this flash.
Let me.
Give me flash. Quick. See, what is hedging in fact?
We have day to deal.
No, it is not a day two, it's something else which I kept it in case we need it. Okay, put it. Okay, where is that? So here it is. Can you people see it?
Yes.
People can see it. Okay.
It is a
See, I
very
would like to use some of the slides which I made for Iran seminar. So there I tried to explain. See, there is a risk. So you try to protect yourself. This is basically hedging. So this is the simplest concept. Okay, now let's go into detail. What is the name of the man?
He's, I think, connecting through phone, so his name is not appearing.
See, for example, you are an exporter. You export to America, and you expect that you will be receiving $500, say in 3 months' time. So, but you are afraid. Sorry, it is mentioned here in Iranian Real because these slides were used for that webinar. But anyway, this will explain you. Assume that you are in Iran and you are exporting goods to America. And you will be receiving $500 in like 3 months' time. So you are afraid that how much you will receive in terms of Iranian Real, which is your local currency, which is your functional currency. Because due to changes in the exchange rate, you may receive a lower amount in Iranian Real than you could have obtained if you could have converted that $500 now. So what you do, you in fact, similarly, another example is, we will be coming back to the earlier example. Similarly, you are you have inventory of oil, and you are worried that about adverse price movement of oil. Today, say it is $50, but you will be selling it maybe in a month's time, and you are worried that its price may not fall below $50. So you will be hedging your value of the inventory. And similarly, you will the earlier one, this one will be hedging his $500 which are due to be received from a customer in America. So likewise, what will happen? So you will here, if you want to protect yourself, what you will do, you will go to say Chicago Mercantile Exchange, and you will sell oil futures. You will sell this commodity in the futures. So now, what are the futures? Futures are basically derivative instruments. And the benefit is, if your oil prices will go down, mean if there is a loss in the open market, in the future market, there will be a gain. So that loss will be compensated by the gain in the future market. So this way you protected yourself, from the adverse movement of your inventory value, adverse movement of oil prices. Similarly, so this will be the hedged item, and this is hedging instrument. Future contracts was a hedging instrument, and oil is basically the inventory of oil is basically the hedged item. Value of the inventory is basically the hedged item, and how you hedged it, this is basically the hedging instrument. Futures are the hedging instrument, in fact. Similarly, in this case, this gentleman will go to a bank, will go to a bank and enter into a forward contract with the bank for selling of $500 at a fixed price. Now this gentleman is sure about, though we started with the Iranian Rial, but I think I forget to change it. I was in fact changing, converting these slides for utilization here in Pakistan, but I thought I forget the earlier slide while changing from Iranian Rial to the Pak rupees. Anyway, the concept is basically like you will sell your dollar by using the forward contracts at a fixed price. Now you know that how much money you will receive at the end of the third month. So this way you hedged yourself, you protected yourself against the adverse movement of exchange rate. So this is hedging. I hope whosoever asks, this is clear. Okay, let's go back to our earlier question, earlier slides, where we were discussing illustration number 5. Okay, here we were like the value of this stock, the value, this is basically the item which need to be hedged. This is basically the hedged item. And future contracts are basically the hedging instrument. The hedging instrument, the instrument which is used for hedging purpose. So this is the hedging instrument. So this is the date when we entered into a future contract for the same amount of inventory. So what will happen? Because our year end is, I suppose, no, before year end we closed it. At 31st December we started on this, and then this was closed on 30th June 2007. Okay. So there are basically two markets. We can go to Word documents to okay. You can use here an empty Word document. See. Okay, you entered into a future contract at what rate? So we can draw over here two markets side by side so that we could discuss both at the same time. You have here inventory, stock, 20,000 kg, 20,000 kg. And currently at the rate of rupees 100. I suppose rupees 100. Yes. No, it is dollar. Dollar 100. Dollar 100 per kg. This is the future market. Futures market, and within that market you sold these 20,000 kgs. You sold this 20,000 kgs at the rate of, you sold this 20,000 kgs at the rate of, ABC Limited was concerned that the price of inventory on 1st July you sold 20,000, 105 at $105 per kg. So this is your transaction in the future contract. Normally, no cost is involved while entering into the future contract. Only you have to pay some cash as a margin. But when the future is settled, when the future is closed, that cash is also adjusted. Those cash payments are normally, or receipts are normally termed as margins. As a security. If you want to enter into like a future contract, you will have to deposit some cash termed as margin with the broker. So otherwise, there is no cost for the future contract. That is not in fact cost. That is in fact a security deposit. Okay. So you sold these future these 20,000 kg of your inventory in the future market. Okay. Subsequently, what happened? Your year end is 31st December 2006. Okay. At 31st December 2006, the end of ABC Limited reporting period, the fair value of the inventory was 110. Okay. Let's account for the next situation. This was the situation on 1st July 2006, and we know that this is hedged item. This is hedged item, and this is hedging instrument. This is hedging instrument. This is hedging instrument. Okay. On 31st December 2006, its price changed to move to the open market. The fair value of the inventory is now 110 per kg. And here in the futures, the price has moved to 113. Excuse me, 113 dollar 113.50 per kg. See, here we can see that there is a gain, but here we can see that there is a loss because we sold at the rate of 105, but on 31st December 2006 you can sell 20,000 kg at the rate of 113.5. So this means we made loss by selling at a low rate. So we will not be closing. We shall only be making entries for accounting purpose. And of course, there will be a margin call from the broker if your initial deposit is not enough in the futures market. So here is a gain. Here is a gain of $10 per kg. So total gain. Total gain will be. Can you please remove the flash because it is disturbing my write-up. Total gain is equal to. Total gain is. Thank you. Total gain is equal to 20,000 kg into gain per kg. Sorry, it should be dollar. Living in a rupee environment, so you again and again write rupees per kg. So this will give us 200,000. So this is a gain of 200,000. It is a gain $200,000. Here is a loss. So we shall calculate the total loss same way. How much is the loss? Loss is basically the difference between these two values. I suppose it is 113.5. 113.5 minus 105. So this will give us $8.5 per kg. So this is a loss per kg. So this will give us 20,000 kgs into dollar, which is loss per kg, 8.5. So this means 170,000 is the loss. This is the loss. Okay, if we go back to our slides, we can see that now what should we do with these gain, with this gain or loss? If we go back to our slide, we can see from here gain or loss resulting from remeasuring the hedging instrument. In this case, futures contract is recognized in profit and loss. And what about hedged item? Same treatment. Hedged item attributable to the hedge risk should adjust the carrying amount of the hedged item. Should adjust the carrying amount. Here, in this case, the value of the stock. Value of the stock will be adjusted, and the second effect will be recognized in profit and loss. Okay, let's go back to our working. There we can see that, okay, for this, so the double entry will be, because there is a gain, and this is the hedged item, which is our stock, we will debit the stock with this amount, 200,000. Credit, as we saw, profit and loss account. So your inventory is debited. So your inventory value is now increased by 200,000. Now for this, credit, we studied day before yesterday. Forward contract at loss. This forward contract is at loss. So this is your financial liability. This is your financial liability. But if forward contract is at gain, then this will be your financial asset. But here, so instead of using financial liability, I can mention over here forward contract account. Forward contract account. Forward contract account. 170,000. And debit profit and loss account. 170,000. So this is basically your financial liability. This forward contract is basically your financial liability. Financial liability. So this way you will be recognizing on 31st December 2012. Okay, now next is This was the year end, we made these entries. Then on 30th June 2007, the traders sold the inventory and closed out the future position at the then spot price of 115 per kg. Okay, now our new date is basically, so here we okay, new date is 30th June 2007. Now what happened? The rate moved to, on this date, $115. Can you see all these material very clearly?
Yes.
Okay. There's no problem in seeing this material. Okay, the new rate is $115 per kg. Again, you can see that there is a gain. There is a gain of $5 per kg. There is a gain of $5 per kg. Okay. And similarly, here we can see that the rate is now, because when on the date of like settlement, on the expiry date, the spot rate and the future rate becomes basically both rates become the same. So on this date, the rate of the future will become 115, at which we can close this future. So here there is a loss. How much loss? 113, the last price, 0.5 minus 115. So there is a loss of $1.5 per kg. So that we will make the same entries as we did on 31st December 2006. Mean here again stock will be debited because there is a gain. The hedged item will increase by this amount, and the total gain is, if we just calculate it, the total gain is equal to $5. The total gain is equal to 20,000 kg into $5. This will give 100,000 gain. So we shall debit stock and credit profit and loss account, because the second effect in fair value hedge will go to the profit and loss account. Here the total, we shall calculate the total loss here. The total loss is 20,000 kgs into 1.5. I suppose this will give us 30,000. So the entry will be debit profit and loss account with 30,000. Credit your hedging instrument, in this case forward contract. Again, this increased in the financial liability. Forward contract 30,000. So this is your, in fact, your financial liability is further increased. Liability. Okay, so far is the treatment. So far is the treatment in accordance with, like we have seen here, in accordance with like this material. Now let's discuss how can we close this assignment, because it is mentioned in the question like this stock was sold on 30th June 2007 and we closed our future position on the same date as well. So what will be the effect of these two transactions? Number one, of course, sale is quite straightforward, profit and loss account, all of you know, and the second is closing of the future. Okay. For sale, the entry will be very simple, assuming that you have received the cash. What is the rate? The rate is 115 into 20,000. Say you received the cash, 20,000. Your sale entry will be simple, 2.3 million. 2.3 million, and credit will be revenue or sales, 2.3 million, and your for cost of sales, your entry will be debit, cost of sale, account sale, with 2.3 million, and credit your stock with 2.3 million. Okay, so this is the entry for related to our stock. Now see, so far you have credited 170,000 to the forward contract and 30,000 to the forward contract. These are the losses. So when you will be closing this account, of course you will have to debit this forward contract account, which is your financial liability. When you settle your, so you will have to pay this money to the other party. 200,000 and credit, say you have paid in the form of cash or bank, 200,000. So this way you will be closing your future contract. If there is a gain in future contract, you will receive the cash for that gain. But if there is a loss, then you will have to settle that loss. So here we can see that if you have any question, you can ask while I'm discussing this, and we shall be popping up a couple of questions now. Meanwhile, if you have any question related to what we discussed, you can ask. See, note that because the fair value of the material rose, ABC Limited made a profit of only 100,000 on the sale of inventories. See, without the forward contract, the profit would have been 300,000. Mean you sold stock at 2.3 million, and its cost was 2 million. So you could have made 300,000 profit. But because you entered into a forward contract, you entered into a hedging arrangement. So a gain in this market was offset by the loss in your future market. But of course, they do not exactly, in this case, they do not match exactly. So that's why you are only able to make a profit of 100,000. Mean In this situation, your position would be better off if you have not gone for the hedging arrangement. But on 1st July 2006, when you intend to enter into the hedging arrangement, you are not knowing if the inventory will end up at a higher price. Had it been the case, or you were very sure about it, you might not have gone for the hedging arrangement. Hedging arrangement is basically related to the future, and future is uncertain. So that's why you, so here in this case, so this is the situation. The benefit of the hedging is like it protects you from the loss. But the negative side of hedging is like if situation turns in a way like you are in a position to make gain, so hedging will restrict your gain as well. So of course, this has this disadvantage as well. Now, please write a pop-up question.
Yes, please.
Pop-up question is, financial liabilities can be reclassified. Financial liabilities can be reclassified. Yes or no? Please pop up this question. While answering this question, if you have any question related to our discussion, related to our numerical working, you can ask that question as well meanwhile.
Okay, this question is not financial liabilities can be classified.
Okay, write another question.
In the meantime, I must convey a message of.
No, it is better during pop-up we should avoid, so that people, if they are looking at something, you can definitely talk to them. The response.
I'm going to close this poll question now. We have 75% people saying yes, while rest of the people are saying no. They are about 25%.
See, what was the question?
The question was financial liabilities can be reclassified. Yes or no?
And what is the percentage of answers?
75% people saying yes.
25% people are correct. 25% people are correct. We categorically discussed yesterday that the financial liabilities cannot be reclassified. Cannot be reclassified. Okay. So the next pop-up question is, for lease receivables, an entity has option has option either to apply general approach or the simplified approach. See, from yes or no?
Should I launch the question?
Yes or no? Okay, yes. See, from general approach, I mean that 3 stages approach.
I think I should close this question now. Okay. It's about 1 minute and 30 seconds. So, 62% people saying yes, while the rest of the 38% saying no.
62% people are correct. 62% people are correct. And okay, another pop-up question, then we can move forward. If we okay, another pop-up question is a financial liability which is held for trading must be measured at fair value through profit and loss. F, fair value through profit or loss.
Yes, sir.
Yes, sir.
Should I pop up?
Yes, pop up this question, please.
Yes.
Please wake up. Answer this question.
So I'm going to close this question now. We have 85% people saying yes, while 15% people are saying no.
This is good. 85% people are correct. I appreciate 85% people that at least our percentage is higher than the last pop-up. Okay, now let's move to the other concept, and that is cash flow hedge.
So one of the attendee was requesting that if these Iranian slides or presentation can be shared with them.
No problem. That can be shared. That's not an issue because all these slides are prepared by myself. I mean, there is no issue of copyright.
Because I told them that these are intellectual property of the trainer, so we have to.
No problem. I'm giving this permission, but in fact, all these illustrations and all the questions which I normally use in my presentations, these are from my books, and I have the copyright of that book, and even I have like entered into an agreement for the copyright from IAS. So that's not an issue. Those slides can be shared. Okay. Okay.
People are saying thanks to you.
You're welcome.
Including Zona.
Welcome, Zona.
She said that could be very helpful as my hedging area is very weak relatively. So it would be kind of you that you are sharing some of that for clarity purposes.
No problem. Zona, even if or Zona or any other person, if they have any specific question related to the hedging, they can send it through my email. Or if you people have any question related to the material being discussed, like we have just discussed the fair value hedge with this illustration number 5. So if any of the point, any of the calculation need to be clarified, so please feel free so that I could answer your query there and then. So it is back. Okay. So this was the accounting of the fair value hedge. Now comes to the cash flow hedge. Cash flow hedge, a hedge of the exposure to variability in cash flows that is attributable to a particular risk associated with all or a component of a recognized asset or liability, such as all or some future interest payments on variable rate debt, or a highly probable forecast transaction, but could affect profit or loss. See, cash flow hedge is basically about your variable items. For example, you issued some bonds with a coupon rate of LIBOR 12 months plus 0.5%. So your commitment is to pay interest at a floating rate, at a variable rate. It means in the future you will pay interest in line with the market because LIBOR reflects the market conditions. But you don't want to pay in line with the market. You want to know how much you will pay in the future, as you need to make some budget, etc. Therefore, you enter into an interest rate swap to receive LIBOR 12 months plus 0.05% and pay 2% fixed. So this is a cash flow hedge. You fixed your cash flows and you will always pay 2%. So you protected yourself from the variable rate. You will always be paying due to this interest rate swap, which is the hedging instrument at a fixed rate. So what are the examples? The examples could be like proceeds from future sales in a foreign currency. So as we saw in these slides, so this person was worried about like about the future amount which he will receive, or when he will convert $500,000 into his local currency, which is in this case Pak rupees. So he will be worried about that. So that's why he entered into a forward contract. So this is an example of cash flow hedge. Second example is forecasted purchase of fixed asset in a foreign currency. May have to pay more in local currency. And similarly, the third one is future interest rate will rise on its debt finance, may have to pay more in the future. See, if you know your machine will cost the exact amount in the foreign currency in the future, and you want to protect just against the foreign currency rate movements, then you can treat as a cash flow hedge. And if you are not sure about the future price of your machine and you are afraid of the price increase in the foreign currency, then it is basically a fair value hedge. Similarly, highly probable future transaction is also a cash flow hedge. But if it is a firm commitment, then this will become fair value hedge, unrecognized firm commitment. But if it is highly probable future transaction, then this is a cash flow hedge. Okay, what is the accounting treatment? Let's discuss about the accounting treatment. The accounting treatment is basically the portion of the gain or loss on the hedging instrument that is determined to be an effective hedge is recognized in other comprehensive income and creates a reserve in equity. The ineffective portion will be recognized in profit and loss. This is very important. See, as we saw in our earlier illustration, that gain in the open market, loss in the forward market, so both are not normally same because both markets are different. Their direction is same. If you just see that, you will most of the time you will find that both markets move in the same direction. If a commodity price is increasing in open market, you will find that the price of that commodity futures will also increase in the futures market. So they will move in the same direction, but not necessarily by the same percentage, or if we talk in absolute term by the same amount, but their direction will be same. So that's why there could be a possibility that the gain you made in one market is different from the loss you incurred in another market. So the difference between these two will be sent to the profit and loss account. So this concept is very important. I will be explaining it, of course, with the help of illustration number 6 at length, and then with a very small illustration as well. Okay, this is the second. So what is the small illustration? The small illustration is, see, just be careful. Let's say change in fair value of hedging instrument is change in fair value of hedging instrument. Hedging instrument is, see, say plus gain $100, dollar or rupees, whatever. Okay. and change in fair value of hedged item. Change in fair value of hedged item is, see, negative. Of course, this will be negative in loss. See, it means that hedge is not perfectly effective. Perfectly effective is an ideal situation whereby there should be a same gain and there should be a same loss. Both should be equal, but that is an ideal situation. In this case, change in fair value of hedging instrument is change in hedged item is 90, whereas in the hedging instrument it is 100. Okay. Now the effective part of change in fair value of hedging instrument is then only 90. So this, because this is being used to protect yourself from the losses. So this gain has got two portion. One is effective portion, and other is ineffective portion. And what is effective portion? Effective portion is in this case 90 and ineffective portion is 10. So this 10 is basically ineffective portion. So this will be credited to the no, in this case yes, this will be sent to the profit and loss, because both will offset each other. This will be like the portion of the gain or loss on the hedging instrument that is determined to be effective hedge, mean in this case 90, is recognized in OCI and creates a reserve in the equity, and the ineffective portion will be, and what is the ineffective portion in this case? 10. I hope this concept is clear, because once I will move from this slide, so this data will be erased, but this will be available in the recording. So if you have any question, you can ask it now. So this is the gain in.
Can you please repeat what is effective portion?
Okay, see, here we have taken an example like hedged item, any hedged item, and hedging instrument. After a period, there is a gain on the hedging instrument, that is 100. And there is a loss on the hedged item, 90. So here, of course, this is the effective portion will be 90. In this gain, the effective hedge mean 90 out of 100 exactly offset your loss. The amount of effective hedge is equal to the loss in the hedged item, in fact. So it exactly like 90 exactly offset your loss in the hedged item. So this is the effective portion of 100. 10 is ineffective portion. This will be charged to the profit and loss. I hope this is clear.
That person is
okay.
Available from a while, so it is
difficult to. Right. Okay, no problem.
One of our members have asked question, but to our previous discussion.
Okay, what is that?
It was by Fateh Fakhri. If the price in the futures has become less the agreed value, is this create a financial asset? Yes, Fateh Fakhri, this will create in this situation. In this situation where you have sold 20,000 kg into the future, if subsequently you sold at $105 per kg,
But if subsequently the price in the future market goes down, like 103, 102, so this will create a financial asset, because now the broker will have will be paying you the difference. Fateh, I hope it is clear.
Can you please quote with some other example the difference between change in fair value of hedging instrument and change in fair value of hedged item?
You are talking about the material appearing on the screen, or you are talking about like illustration number 5 related to the fair value hedge? Please make it clear. Who is this gentleman? Fateh Fakhri?
No.
Okay. Okay, no problem. So it is better you should mention your
appearing on the screen.
Yes, appearing on the screen. Okay, no problem. We are going to discuss illustration number 6, which will explain this point again. So there you will find that this point may be explained 3-4 times. So it is better. Okay. Next is, and what happened when at the date of the settlement, when a hedging transaction results in the recognition of an asset or liability, changes in the value of the hedging instrument recognized in equity either are adjusted against the carrying value of the asset or liability, or affect the profit or loss at the same time as the hedged item, for example, through depreciation or sale. So this is the basically accounting treatment of cash flow hedge. So this accounting treatment can be explained with the help of an illustration. But before going for the illustration, we can have a small pop-up question. Okay. Write on the pop-up question, please.
Yes.
An unrecognized firm commitment. Hedging, an unrecognized firm commitment is a fair value hedge. Is a fair value hedge? Yes or no? Please, pop-up question is in front of you. No, yet not popped up, but in a while the question will be in front of you. Please answer this pop-up question.
Question has been popped up.
Okay.
Hedging unrecognized firm commitment is a fair value hedge. So I'm going to close this poll now. So those who left must submit right away. Please. Okay, I'm going to close this now. We have 56% people saying yes, while 44% people saying no.
56% are correct. This was very straightforward question, and it is clearly mentioned on the slide, like unrecognized firm commitment is a fair value hedge, isn't it? Okay, the answer yes is correct. 56% people are correct. Then another pop-up, and then we will be having a short break. And during that short break, please go through your material of today, yesterday, day after tomorrow. And if you have any question which need to be explained, so please feel free to ask. Okay, and another pop-up is. Okay, you enter into interest rate swap.
Interest rate swap.
To receive variable interest rate.
Variable
interest rate and pay fixed interest rate. Full stop. Name the type of hedge. Name the type of hedge. Option 1. Option 1, fair value hedge. Option 2, cash flow hedge. Option 2, cash flow hedge. Please pop up this question. Pop up this question,
yes,
please.
Yes. Yes. I'm going to. Okay. The question has been popped. So I think I must close this poll now. So we have 39% people saying fair value hedge, while 61% people saying cash flow hedge.
61% people are correct. 61% people are correct. This is an example of cash flow hedge. Please remember this. When you receive interest rate at a variable rate, and you pay interest at fixed rate under interest rate swap, this is the cash flow hedge. Okay, so now we can have a short break. Okay, welcome back. Okay, let's discuss the illustration related to the cash flow hedge. There, I will be explaining again this effective and ineffective portion, and not only that area, but also the slide which is in front of you, which says when a hedging transaction results in the recognition of an asset or liability, changes in the value of the hedging instrument recognized in liability either are adjusted against the carrying value of the asset or liability or affect the profit or loss at the same time as the hedged item, for example, through depreciation or sale. Okay. No, let's go to the illustration. Before going to the illustration, can you please read questions which we have received from the participants?
Yes, we have some questions from the participant. Mr. Supposed to be Shakil Zulfikar. What will be the effective and ineffective portion where if situation is reversed, value of hedging instrument is 90 and hedged instrument is 100? Please tell what will be the effective and ineffective portion.
See, again, the 90 will be the effective portion. You're in fact discussing like hedging instrument gain 90 and hedged item loss 100. So again, the effective portion is 90, but there is no ineffective portion because we need to divide this gain. So the whole 90 will can be used to offset this loss. This is not fully effective. This is not perfectly effective, but there is no ineffective portion here. Shkil, I hope it is clear. Other question?
No question.
Okay. Okay,
yes,
the illustration.
Saying yes.
Okay. Illustration number 6. Dynamic Steel Limited. Dynamic Steel Limited signed an agreement on 1st June 2013 for import of equipment for SK 50 million. SK is used for like any foreign currency. According to the agreement, the plant was delivered on 1st November 2013 and invoice thereof was paid on 1st December 2013. In order to hedge the commitment to pay 50 million SK, on 1st June 2013, DSL entered into a forward contract to buy the required SK. SK means foreign currency on 1st December 2013 at a fixed exchange rate of 1 SK is equal to rupees 15. Exchange rates on various dates are as follows. On 1st June 2013, mean when we entered into the forward contract, spot rate was 14.5 rupees against 1 SK, and forward rate which we used was 15 rupees per SK. Then on 30th September, which is the year end of the company, spot rate moved to 12, and forward rate for the same time period is 12.39. And on 1st November 2013, when we actually received the property, plant and equipment, spot rate was 11.15 and the forward rate was 11.35. And on 1st December 2013, when the forward is actually settled, the rate was 10. Of course, on the same date, if you take the forward of the same date, that will become the spot rate. It is DSL policy to adjust any gain or loss arising on forward contracts to the carrying value of the imported goods. DSL accounting year end is 30th September. Required. Prepare accounting entries relating to the above transactions on each of the above dates in accordance with the requirements of the IFRS. In accordance with the requirements of the IFRS. Okay. So let's use an empty Word doc. I suppose we have one here, and this material should be, this illustration should be in front of you. I suppose you must have downloaded the material. Okay. Can use the next page so that we can have good space. Okay. Okay. So here, see what is the basic transaction. The basic transaction is like we have to pay some money at the on I suppose on 1st December 2013. So we have to make payment of SK 50 million. SK 50 million. SK 50 million. This is our hedged item. And we used the forward contract. We used the forward contract for this 50 million, SK 50 million forward contract. So this is our hedging instrument. So you can note that unlike fair value hedge, this hedged item is not part of our accounting record. Sorry, I would like this payment, in fact, is not part of our accounting record. Why? Because we have not yet received the asset, property, plant, and equipment. When we will receive that, only then it will become payable. Right now, we are waiting for that property, plant, and equipment, for which we are required to pay 50 million SK on 1st December 2013, and we will receive this property, plant, and equipment on 1st November 2013. So this means on 1st November 2013, this will become our liability, no problem. But right now, when we are talking about, and which is the date is in fact when we are talking about 1st June 2013. On this date, when we know that we will have to pay this much amount on 1st December 2013, and this amount is not a part of our like accounting record, because we have not received that property, plant and equipment. We will be receiving property, plant and equipment on 1st November, and we will have to pay SK 50 million on 1st December, mean 1 year after the receipt of the property, plant and equipment. But today it is 1st June 2013. So this is interesting. Okay, forward contract. When we enter into a forward contract, now we shall pass a double entry for this transaction. Okay, so this means only what we will do, either hedging instrument will increase or decrease. Gain or loss on the hedging instrument will affect the other comprehensive income and the hedging instrument. There will be two effects on. In fair value hedge, you noted that I divided my page into two. On one side, I was calculating and I was passing double entry in the stock. In fact, increasing or decreasing the stock with the gain or loss on the fair value changes. And on the other part of the page, I was treating the gain or the loss on hedging instrument and passing the double entries. Here, I will be calculating the gain or loss on hedged item. I will be calculating the gain or loss on the hedging instrument. But the double entry will only be passed for the hedging instrument, which is part of our accounting record. So far as the hedged item is concerned, unless it is recognized, that is not part of our accounting record, so that is only a reference for the purpose of calculation. No journal entry will be passed for hedged item. Okay, let's move now. Okay, the next date is on like 1st January 2013. Okay, if I subdivide my page, here I will be calculating the gain or the losses for hedged item, but will not be passing any double entry. I am repeating again and again. I'll not be passing any double entry. And here I'll be calculating gain or loss on hedging instrument, which are the forward contract, and I will be passing the double entry to incorporate the effect of gain or loss on the hedging instrument. See, on 1st June 2013, I suppose 13, yes, 2013, no adjustment, but we know that the spot rate on this date is basically 14.5 rupees. This is only a reference for the purpose of calculation. 14.50 per 1 SK. This is the rate. Where on this date, on this same date, you entered into a forward contract to buy 50 million SK forward contract just 1 minute. Okay, forward contract to buy 50 50 million at the rate of as given over here, rupees 15 per 1 SK. So no entry will be made, though this is your like transaction, but and this is part of your accounting record, because initially no cost is involved. I mean, in fact, no cost is involved while you enter into a forward contract. So no entry here on this date for the forward contract. Okay. Subsequently on year end, on 30th September, on 30th September 2030, what happened? Spot market moved to 12 rupees 12 per 1 SK, and forward rate has moved to, on the same date, rupees, as given in the question, 12.39 per 1 SK. So you can see that because we want to buy SK 50 million in the open market, the rate is decreased from 14.5 to 12. So the rate is decreased because we want to buy SK. If the rate is decreased, so this means there is a gain. There is a gain. Okay, here is a gain. How much? Let's calculate. Gain is equal to 14.5 minus 12. This will give us the gain. 14.5 minus 12. Rupees 2.5 per SK1. This is the gain. And this gain is only a reference. This gain is only a reference. Okay, what is the total gain? Total gain. Total gain is equal to 2.5 into SK 50 million. So the total gain is, in the spot market, 125 million. Okay, now comes to the forward market. Of course, there is a loss because you entered into a forward contract at the rate of 15. This means you will be able to buy this 50 million at the rate of 15. Okay, so what is the loss? Loss is equal to 15 minus 12.39, because you entered into a binding agreement on 1st June 2013 that you will buy 50 million SK at the rate of rupees 50. But subsequently, like on year end, on 30th September 2013, the rate is moved in the forward market to 12.39. This means now you can buy the same forward contract mean on 30th September 2013 at the rate of 12.39, whereas you already entered into a forward agreement at the rate of 15. So this means you made a loss. So what is the loss? The loss is basically 15 minus 12.39. So your loss is basically 2.61. And the total loss will be equal to 2.61 into 50 million. So this will give you 130.5. So this is the total loss. As we discussed earlier, we will pass entry here. We will pass entry here, no entry here. We will pass, see, first of all, we shall calculate the effective and the ineffective portion. See, what is the effective portion? Here, the total loss is 130.5. 130.5. So the gain of 125, effective portion of this loss is basically equal to this gain. $125 million. The remaining portion is basically ineffective portion of this loss. And that is 130.5 minus 125. So its calculation will be 130.5 minus 125. So this will give us 5.5. So this is ineffective portion. This is ineffective portion, and this is the balancing figure. Balancing figure. So what is the entry? The entry will be, as we discussed earlier, no entry here, but on this date, mean on 30th September, which is the year end 2013, the entry will be debit other comprehensive income account with the effective portion, and debit profit and loss account with ineffective portion, and credit financial liability, which is the forward contract, because now the forward contract is at loss. So when the forward contract is at loss, so that is your financial liability. We know from our previous discussion. You can use the word over here like forward contract, but in fact being credited, so this is your liability. So this will be credited with 130 point with the total loss. So this is your basically forward contract. We are not making any entry on this side because this is not yet recognized. This is only a reference for the calculation of gain or loss and to see what is the effective portion and what is the ineffective portion. Okay, now subsequently the next date is when we, I suppose, receive the fixed asset. Okay, on 1st November we receive the fixed asset. So there will be in fact 2 entries. See, on 1st November 2013, what was the spot rate? The spot rate was moved to, on 1st November 2013, when we actually received this fixed asset, the spot rate is moved to sorry, rupees 11.15 per SK1, whereas the rates in the forward market moved to, forward rate moved to rupees 11.35 per 1 SK. Okay, again we shall calculate gain or loss. Again we can see that on 30th September the rate was 12 and this rate is further reduced. So this means again there is a gain, and the gain is equal to the previous rate and the current rate. So this will give us gain on the gain in the spot market, 0.85 rupees. Okay, so we can calculate here the total gain. Total gain is equal to 0.85 into 50 million. This will give us 42.5. 42.5. 42.5 million. Likewise, there is a loss, and loss can be calculated from the last rate, which is in the forward market. The last rate was 12.39. 12.39. 39 minus 11.35. This will give us a loss 12.39 minus 11.35. The loss is 1.04, and the total loss is, and total loss is equal to 1.04 into 50. So this will give us 52 million, the total loss. See, again, here we shall pass an entry for the property, plant and equipment, of course. because on this date we have received the property, plant and equipment, so there will be an entry. But before that, on the same date, but before that, here we can calculate, we can bifurcate this loss into the effective portion and the ineffective portion. Effective portion, as we know from our earlier discussion, this is the effective portion. 42.5 million. And ineffective portion, is basically the balancing figure, which is 42.5, 9.5. So 9.5 million is the ineffective portion. So we shall be passing a double entry for this. So this is required for moving to the next page. I suppose I will be able to do that without mixing so many things. I think I am mixing. Okay, let me take it back. Okay, let me check. Okay, 9 point. Can one step. Okay, 9 point I have here. 9.5 I can use here. 9.5. So from here I can use another doc so that the work is not mixed up. So the entry will be debit OCI, mean other comprehensive income, with the effective portion. The ineffective portion will go to profit and loss, and of course credit financial liability, forward contracts, because we are incurring a loss on these forward contract, which is the total loss. These are the forward contract. So this will continue because this will close on 1st December when we actually make the payment. Now what happened here? We know from our last page, I can mention over here, this is number 2. Hedged, this is basically the sides of the hedged. This is, I suppose this is basically hedging instrument. This is basically hedging instrument. Hedging instrument. Forward contract, hedging instrument. And on this side, basically, hedged item. Okay, now what happened? Now you have received the property, plant and equipment. So you will be making an entry for the property, plant and equipment. Okay, debit, property, plant and equipment, or non-current asset. non-current asset. For short, non-current asset account with an amount as per International Accounting Standard 21. When you buy an asset, so you will record your asset. Okay, first of all, create the payable, then this will become the balancing figure. Okay, what is the payable in fact? The payable is basically credit account payable. What is the rate at this stage? The rate is 11.15. Rate is 11.15. So the calculation will be 50 million SK into 11.15. 11.15. So this will give you 557.5. Let me correct it. 500. 557.5. Now let's go back to our slide. From there we can see that a very important principle, and that is when hedging transaction results in the recognition of an asset. Here that hedging transaction is resulting in the recognition of non-current asset, mean property, plant and equipment, non-current asset. So what we will do? So you have two options. This number one or number two. Here what we are going to do, we are going to adjust the carrying value of the asset or liability. Carrying value. The total amount which we recognized in OCI will be transferred to the non-current asset. And how much we transfer to the OCI, and that is basically, we know, we can see from here the amounts which we have transferred in OCI. Okay, this is one amount. This is one amount debited to OCI. Please remember it, 125. And another amount which we transfer to OCI is, yes, here on the next page. 125 on this page, and on the next page we transferred 42.5. So this means total amount transferred to OCI is basically, if I mention over here, 125 plus 125 plus 42.5. So this is the amount which is debited to the OCI. 125 plus 42.5. 167. Now we are recognizing this asset. So this will be, what we will do, we will reverse this amount. We will make OCI 0 by crediting OCI, because 167.5 is debited to the OCI over the over the period from 1st June 2013 till this time. So we shall be reversing this amount and adjusting it, making it a part of the cost of the non-current asset. This is as per the principle number 1. So this will give us this property, plant and equipment will be recognized at 725 million. 725 million. So this way you will this way you will transfer basically. This is basically the requirement given in 1. Like you will adjust the carrying amount of the asset. Here we bought property, plant and equipment, so we adjusted that because this is the hedging transaction results in the recognition. This hedging transaction results in the recognition of a non-current asset. So the carrying value of the non-current asset will be adjusted. What is the meaning of adjustment? This means you will have to transfer whatever amount lying in the other other comprehensive income and should be included in the carrying amount of that asset or liability. Okay, so this is entries on 1st November when this happened. Now on 1st December, what happened? On 1st December 2013, our forward contract is closed on this date. We can note the rate of the forward is further moved. Okay, let me use the question given in slide. There we can have figures. Yes, here you can see that here we have closed this. This is the last day of the forward rate. Of course, that will be equal to the spot rate. That cannot be termed as a forward rate, but if we say, okay, this is 1 day forward, so that is normally equal to the spot rate. So the spot rate is 10. So what happened? Again, we can see that there is a further loss, and which is equal to further loss is equal to what was last rate? 11.35 was last rate. Now this is no longer part of our hedging arrangement. Now this is purely a separate only derivative instrument. Minus 10. So this is basically 1.35 is the loss. So you will be calculating the total loss. Total loss is equal to 50 million into 1.35. So this will give you, because this forward contract is for 50 million SK. So 1.35. So 67.5. But here the important point is now there is no hedged item. So this is only now a derivative instrument, and we know from for derivative instrument they are always measured at fair value through profit or loss. So the double entry will be for recording of this loss, profit and loss account 67.5 million debit, and credit financial liability, which is a forward contract. Financial liability, which is a forward contract, that will become 67.5 million. So this is forward contract. Now, because the contract is closing on this date as well, so we shall be closing this forward contract as well. on this date. If you just recall, so on this date, we shall be closing this liability as well, the liability of 50 SK, which arose on 1st November 2013. But that will be a simple treatment. We know that that is basically your liability in foreign currency. When you will be settling that foreign currency liability, whatever is the exchange gain or loss, that will be transferred to the profit and loss account. And here, when you will be closing this forward contract, so this is your financial liability. You will have to pay cash in order to settle it. So your financial liability will be debited with the total amount. What is the total amount? In fact, you will add up the amount which you credited to the financial liability forward contract account over the period, from the date of its inception till this point when it is being closed. So the total change will be, I suppose, it was basically on 1st we transferred the loss of 130.5 plus on next date it was 52, and now it is 67.5 as it is written above. So the total will become 250. So you will have to pay cash of 250 equal to the loss. See, remember, if there is a gain, you will receive the cash. But this is not the cash, in fact, you will be paying at this point in time. Practically what happens when there is a loss, in case of futures market, not in forward market, when there is a loss, the broker keep on like calling you for deposit of the margin, for making that loss good, so that the loss is not big enough that there is a chance of default. So regularly you will have to make this loss good from time to time in the futures market. Okay, so you will be paying this much to the bank for settling of this forward contract. And here we know that we have a liability, financial liability account in the form of account payable, and the amount which we recognized, we can see from the top, amount which we recognized was, in fact, the amount which we recognized it was basically 557.5. This was the amount, but in fact this is denominated in the foreign currency. Of course, when you will be paying, you will be buying from the open market this SK 50 million. Whatever is the rate is at this point in time, the rate is in fact 10, I suppose 10, it is 10. Let me check, is it 10? Yes, it is 10. You are paying this liability. So this means, in fact, you are paying cash 500 million. How? Because you bought 50 million SK at the rate of 10. So in fact, you paid cash 500 million, but your liability, total liability was 557. Why? Because when you recognize this liability, at that time the rate was such that this was the liability in Pak rupees. So simply the difference will be credited to the profit and loss account. This is exchange gain, in fact, 57.5. This is as per International Accounting Standard 21. Simple. This is a transaction. This is a liability which you are required to pay. and on 1st December 2013 you made this payment, and but while making this payment you only paid 500 million, because at that time the rate reduced, and you paid lower amount than the liability you recognized previously. So the difference will be credited to the profit and loss account. So this is the whole story. See, the next is like uh, the effective portion of your hedging arrangement is now a part of your property, plant and equipment. So because that is a part of the property, plant and equipment, then subsequently it will be depreciated. It will be depreciated, and I mean, as we have seen in our slide. If we have any question, so you can read that.
Only one question.
Okay.
Can we have answers for the handouts at the end of the session or later onwards as per our ease?
No problem, because we are solving it on the document uh, of the system, which is right now available with us. So I request Khyam that he should save these documents and send these answers along with other material.
What kind of material?
Mean other material, like if you will be sending like Iranian slides or something like this, then you can send this material as well. Solutions.
I will update the documents on the Google Doc link that have been provided to them, and they will be available there.
Now we can have a short break,
Yes.
and then when we will come back, if we have any question, okay, fine. Otherwise, we will go for IFRS 7. No, we have some material related to hedging, but the main discussion of the hedging is over. Okay. So we were discussing this accounting treatment, and now the next part of the hedging, and that is basically yes, that is basically related to hedge of net investment in a foreign operation. It's very simple. An overseas equity investment, that is a subsidiary, associate, or a joint venture. Uh, so in that case, a joint venture, so that is basically hedge of net investment in foreign operations is basically this type of hedge shall be accounted for similarly to the cash flow hedge. So this means if we really able to appreciate the principles of cash flow hedge, so then the same principle will be applied to the hedge of net investment in a foreign subsidiary. Okay, the effective portion of the foreign currency gain or loss on the hedging instrument shall be recognized in other comprehensive income, matched with the foreign exchange gains or loss on consolidation. The ineffective portion shall be recognized in the profit or loss account. When the hedged item is disposed of, the cumulative gain or loss in other comprehensive income shall be recognized as part of the profit or loss on disposal. So very few of you will be in a position to apply this accounting treatment, because those people who are working in a group, but in fact not only group, but they are handling group accounts, and where foreign subsidiaries, foreign joint ventures, foreign operations are involved, and there is a risk of they want to hedge the risk associated with such operations. There they will be applying these guidelines, but most of the people will not be requiring this accounting treatment, even if they are sitting in the group, because a lot of people are working in the group. Not everybody is required to carry out these transactions. Okay, what are the major changes? What are the major changes? See, the major changes are, number one, same as, so far as the fair value hedge is concerned, this is the same as International Accounting Standard 39. In addition, IFRS 9 ensures that hedges of investment of equity instrument held at fair value through OCI can be accounted for as hedges. Before, this was not the case. Cash flow hedge, this is the same as old IAS 39. Then is hedging of net position was not permitted under ISA 39, and under IFRS 9 this is permitted. Sometimes you have assets, you have liability, but you want to hedge the net exposure, so and want to apply the hedge accounting. Now it is permitted under IFRS 9. Before it was not. Then there are some new requirements, like an entity can no longer discontinue a hedging relationship voluntarily. This is permitted under ISA 39. Now you cannot. An entity shall discontinue hedge accounting prospectively only when the hedging relationship fails to meet the qualifying criteria. If it continues to meet the qualifying criteria, then you cannot discontinue. The risk management objective have changed, or the hedging instrument has expired, is sold, or has terminated. Mean IFRS 9 has given an objective criteria for discontinuance, whereas under ISA 39, an entity can opt to discontinue voluntarily the hedge accounting. Next is International Accounting Standard 39. Talks about like 80 to 125% criteria. Now this has been replaced by the more objective test based on internal risk strategies. See, an entity would anticipate that the gains or losses will offset before it enters into any hedging relationship. 80 to 125% criteria to measure the effectiveness is no longer there. Instead, the hedging relationship is anticipated to be effective throughout the life of the hedge by meeting all of the following requirements. For example, there is an economic relationship between the hedged item and the hedging instrument. Economic relationship means the prices of both move more or less in the same direction, and there is no much difference in their movement, but guidelines are not prescriptive. I mean, you yourself have to decide, okay, is it effective or not. The credit risk does not dominate the value changes. The hedge ratio is effective. I mean, you can see that, okay, losses are being substantially offset by, but there is no 80 to 125% range. Then you can rebalance. I mean, you can rebalance your hedging arrangement. Previously, you cannot. Under ISA 39, you cannot rebalance your hedging arrangement. For example, like there are changes in the market, you feel that in order to hedge the same level of exposure, you need more future contracts. So you can like buy more future contracts to become part of your hedging arrangement. I mean, you rebalance your hedging arrangement. This was not allowed under ISA 39. Under IFRS 9, if the hedge effectiveness requirement is not met, the hedged item and the hedged instrument do not move in relation to each other as expected and documented, but the risk management objectives remain the same, and entity is permitted to amend or rebalance the hedge or to continue to apply the hedge accounting rules. So these are the basically changes as compared to International Accounting Standard 39. These last three slides are especially important for those people who are practically applying this hedge accounting, so they can see what is new in IFRS 9 for them, so that previously if they were prohibited from doing something, or they were bound by prescriptive rules of ISA 39, now they can see what leverage this new standard will bring for them. Okay, so this is all about related to IFRS 9. We started its discussion day before yesterday, and now let's move to our last standard, which is IFRS 7. IFRS 7, can you please, do we have a flash here? IFRS 7, I suppose it is on the desktop.
Yes. FIS part 3.
Okay, thank you very much. IFRS, no, it is not here. Okay, is it here? No, it is not here. It is in the flash. Can you please just here. Okay, International Financial Reporting Standard 7. This is a very straightforward standard, in fact. So that's why even few minutes are enough. This is basically a list of disclosures required for financial instruments. Main categories of disclosures are two. You have to disclose significance of financial instrument, and the second category is nature and extent of risk arising from that financial instrument. Okay, first of all, in significance of financial instrument, in statement of financial position, disclosure for each of the following categories. Financial asset measured at fair value through profit or loss, showing separately those held for trading and those designated at initial recognition. Held to maturity investment, loans and receivables, available for sale assets. Financial liability at fair value through profit and loss, showing separately those held for trading and those designated at initial recognition. Financial liabilities measured at amortized cost. And then other disclosures are special disclosures about financial assets and financial liabilities designated to be measured at fair value through profit and loss, including disclosures about credit risk and market risk, changes in fair values attributable to these risks, and the methods of measurement. Reclassifications of financial instrument from one category to another category, from fair value to amortized or vice versa. And today, I used this reclassification concept in our pop-up question. Okay, other disclosures are information about financial asset pledged as collateral and about financial or non-financial asset held as collateral. Reconciliation of the allowance account for credit losses, bad debts by class of financial asset, different class based on what are the classes in your account. Information about compound financial instrument with multiple embedded derivatives, breaches of terms, and then in statement of comprehensive income, items of income, expense, gain, losses with separate disclosures of gains and losses from financial asset measured at fair value through profit and loss, and showing separately those held for trading and those designated at initial recognition, held to maturity investment, loans and receivables available for sale. The same classification which we saw earlier, but here you will have to mention as per this classification income, expense, gains and losses. Total interest income and total interest expense for those financial instruments that are not measured at fair value through profit and loss. Fee income and expense, amount of impairment losses by class of financial asset, interest income on impaired financial asset. Other disclosures are accounting policies for financial instrument, information about hedge accounting including description of each hedge, hedging instrument and fair values of those instruments, and nature of risk being hedged. For cash flow hedge, and then for cash flow hedges, the period in which the cash flows are expected to occur, when they are expected to enter into the determination of profit or loss, and a description of any forecast transaction for which the hedge accounting had previously been used, but which is no longer expected to occur. If a gain or loss on a hedging instrument in a cash flow hedge has been recognized in other comprehensive income, an entity should disclose the following: the amount that was so recognized in other comprehensive income during the period, the amount that was removed from equity and included in profit or loss for the period, the amount that was removed from equity during the period and included in the initial measurement of the acquisition cost or other carrying amount of a non-financial asset or non-financial liability in a hedged, highly probable forecast transaction. For fair value hedges, information about the fair value changes of the hedging instrument and the hedged item. So I can see here like slide numbers are not correct. So inshallah, Mr. Khayyam will correct these slide numbers before sending it to you. Its sequence is not correct, but otherwise the way they are appearing, that is correct. Similarly, hedge ineffectiveness recognized in profit and loss separately for cash flow hedges and hedges of a net investment in a foreign operation. Information about the fair values of each class of financial asset and financial liability, along with comparable carrying amount, description of how fair value was determined, the level of inputs used in determining the fair value, reconciliations of movements between levels of fair value measurement hierarchy, additional disclosure for financial instrument whose fair value is determined using level 3 inputs, including impacts on profit and loss, other comprehensive income, and sensitivity analysis. Information if fair value cannot be reliably measured. Then fair value hierarchy, what you have used, level 1, level 2, level 3, as per IFRS 13. The disclosure of fair value is not required when the carrying amount is a reasonable approximation of fair value, such as a short-term trade receivable and payables, or for instrument whose fair value cannot be reliably cannot be made reliably, because we know that trade receivables are a common feature in the balance sheet of all organizations. So if they are short-term, you will be receiving them within a period of 12 months, so there is no need that you should disclose their figure. Then nature and extent of exposure to risk arising from another category. So in this category, qualitative disclosures describe risk exposure for each type of financial instrument, management objectives, policies, and processes for managing those risks, changes from the prior period, and the quantitative disclosure provide information about the extent to which the entity is exposed to risk based on information provided internally to the entity's key management person. And these includes, here is a list, you can see that. Then you will have to disclose the nature and extent of exposure related to your credit risk, liquidity risk, market risk, transfer of financial asset, transfer financial asset that are not derecognized in their entirety, transfer financial asset that are derecognized in their entirety. As we discussed yesterday, in fact, this new standard will drastically affect banks and other financial institutions, because these institutions use a lot of financial instruments. You will find a lot of financial instruments on their balance sheet. So, and any other organization which uses or where there are a lot of financial instruments on their balance sheet. And thank you very much from my side for attending this long session of 9 hours, in which we tried to cover the main concept of International Accounting Standard 32 and International Financial Reporting Standard 9, and very briefly International Financial Reporting Standard 7. International Financial Reporting Standard 7 is, in fact, you can see that is a checklist. In whatever is applicable to your organization, of course, you will have to disclose accordingly. So, Mr. Khayyam, can you pop up feedback question so that we could close it?
Okay, I'm going to pop the feedback question right now. It's on the screen now. You guys also link such sessions on internal, external auditing. Sanaula. Thank you, sir.
Snaula, you are welcome. Snaula, you are welcome. Snaula, in fact, we shall be having a session on maybe key audit matters or a couple of other important auditing standards. And, the schedule will be communicated to you soon.
We have our feedback question popped up, and it's about around 2 minutes. So 30% people have voted for that. I think I must close it. The statistics are shown on the screen of the participants, and there are 36% people saying excellent, while 55% people saying very useful, 9% people saying good, and rest of the audience are saying thanks to the trainer. I must mention their name, Fateh Fakhri, Sanaullah,
Fateh Fakhri, Sanaullah. Thank you very much.
Arsalan Rashid,
Arsalan. Okay.
Farhan Zakka is asking a question: what are embedded derivatives?
Embedded derivatives, a derivative which has two parts. So we can discuss in some other session embedded derivatives.
Awais Rana asking, saying it was really good session. Usman Yusuf while saying when session will be conducted on IFRSs that are applicable in Pakistan.
Mean we shall be sending you the dates once it is finalized. Of course, we will be running that seminar in 2-3 weeks time. That will be basically part of our updates when we shall be discussing very briefly what are the updates which are applicable from this year. So we shall be including within that session the information about standards applicable here in Pakistan.
Okay, one more question from I think great to have Mr. Abu Bakr. It was a good session by Muhammad Muzammil Ahmed Khan.
Muhammad Muzammil, you are welcome. Thank you very much.
Many thanks. Also, okay, I'm going to forward now the question related to their residency from where they are attending the session. Please spare some more time and participate in this poll. So guys, I am going to close this poll as I think most of the people have submitted their residency from where they are attending the session. So those who are saying other, I must request them to please answer in the question box or chat box mentioning their country from where they are attending the session right now. I am going to close and share the statistics on the screen. That is 47% people saying that they are from Pakistan, 40% people saying Middle East, 3% people saying Sri Lanka, 6% people saying Bangladesh, while 4% saying other. So thank you everyone that they have turned up and attended our sessions, and I hope all you guys have benefited from the knowledge that have been imparted, and I hope that you will be able to apply this knowledge in your practical scenarios. I hope that we have one last session that will be also beneficial for you, inshallah. And thank you everyone from ACCA side. And the trainer have also conveyed you many thanks and best wishes. So good luck and have a nice weekend. Take care. Goodbye. Allah Hafiz.